Dude, so what an absolute monster move in the NASDAQ this week. It's just on a tear. Bears are in shambles. And I wonder how long it's going to last because growth is definitely slowing. We saw some jobs numbers come out today, and it's not what it used to be. But it's kind of a bad news is good news type of situation where, like, that means the Fed's going to cut, which is good for the Nasdaq. Is that how you see it? Because that's how I'm seeing it.
Right. Yeah. So that bad news is good news is really um we could talk about that for a second, right? Because that whole saying is a bunch of nonsense, right? Like when in terms of like the way it's spoken to about on X and whatnot, right? Like we look back, it's been bad news is good news this entire rally up, right?
Yeah, but like growth was
But
strong. Like we were
right,
seeing like the Atlanta Fed forecasts for GDP coming out like way above expectations, and now we're seeing that starting to pull back as well. So now it's actually
right,
like
but
growth is slowing.
the bad news is good news is only something people contextualize for the day, right? For example, bad weaker unemployment data came out, right? That's bad, but it meant the Fed would cut, so stocks went up. It was good, but all in all, the weaker unemployment data that was coming out, or whatever it was, if it was weaker manufacturing data, whatever it was weaker, but not bad. So it was weaker, but still good. This whole idea that bad news is good news, that's why the stock market is continuing to hit new all time highs. I think that's a lot of nonsense, right? In terms of like the actual news and context, most of it is good news. It's just softer than what we were experiencing at an earlier stage of the cycle. So it's not necessarily bad, right? It's not like we are having negative NFB numbers or what it may be, right? Like it's just not as good. So people look at it like, oh, it's bad, but it means the Fed's going to weaken or loosen, excuse me. And even though the economy is weakening, it's now good because we're going to get easier monetary policy in the future. But all in all, it's not bad because if it was bad, what would be happening is the market would be crashing and the Fed would have to be panic cutting, right? If it was really bad news.
Yeah, but isn't that something that the market would foresee happening? Because historically, unemployment, once it starts rising, it's kind of like a slow grind up, and then it's fast and instant, and then that's when the Fed gets put in that position where they're panic cutting. Like, wouldn't the market be foreseeing that happening once we're starting to see that unemployment rate really start to grind up like we are seeing now?
Oh, absolutely. But you have to also look at it like this, right? The unemployment rate is at 4.1%. It's not even like we'll look at that right here. It's not even significantly higher in terms of the overall context of history. It's up. It's we the labor market is 100% softening, which is what we want to see to get easier policy conditions from the Federal Reserve. But there's no panic here yet, right? I think that this will continue to weaken. Well, I don't want to say at a 45-degree angle, but it will continue to grind higher over the next, three to six prints, likely into the end of the year. And the Fed would have already had to have started cutting. That's what I'm thinking is going to happen here, right? But in terms of like 4.1% in terms of where we've been from 2022 on going sideways, yeah, it's definitely weakening, right? But if you zoom out, it's like, okay, I mean, it's not really exploding higher, but to your point, you're right. If the Fed sits here and does nothing and says, "Oh, we really want to see the labor market loosen," which is what they have been saying, or loosen up, not or soften up. I don't want to say like deteriorate drastically before they start reducing rates. Um, if they wait on that, then yeah, this is going to have really like it's going to start skipping at some point. And we don't want to see this start skipping up because that becomes actually bad news.
Yeah,
And that
that's
isn't
when we'll see the Nasdaq actually go down.
yeah, and I think that we're in a situation right now where back to our compound landing theory, but we don't have to get in the weeds of that. It's very simple. The data's softening, we're slowing down, but we're not in a recession. Slowdowns don't equal recessions, but slowdowns can turn into recessions if they're left untreated for too long, right? And I think the situation we're in right now is the unemployment level is already above the Fed's forecasted rate for this year, right? We're already above that rate, or at least the median for 2025,
Yeah,
right?
which is funny. I
So
remember you were talking about that a few podcasts ago, how it's just not a realistic expectation that they set for themselves.
yeah, it's funny because they almost in the last dot plot, they essentially linked the entire premise of their shift in hawkishness on the in forward expectations to the slight uptick in unemployment expectations on their end, right? They actually didn't do much to their labor market forecasts. They really just lifted their inflation expectations and based their entire reason of being hawkish on those forecasted updates. It was the labor forecast that caught me or caught my interest because it really wasn't up enough to the point where you would say like, oh great, like the Fed's really just pricing in a robust, extremely robust, or I should say it the other way. The Fed is pricing in labor market weakening to such a degree, and they're still this hawkish. Like to give some context to what I'm saying, in their median for 2025, right, is 4.2%. We are now at 4.1%. Their median for 2024 is 4%, right? So we're already above the 2024 median, and we're getting into almost going to be at the 2025 median. So unemployment's pretty much exceeding the Fed's forecast in terms of the rate that it's rising. So we're already putting the Fed in a tough position in terms of unemployment. Now, it's the inflation forecast that's going to obviously that has been and will continue to likely push and pull us around here. I mean, they're looking for PC to have a median of 2.3% in 2025. And right now, it doesn't, I mean, we can just look at here. So let's see if we can do PC index. It will change. So 2.3%. You're talking about a 30 basis point slide here by 2025. I think that's very feasible, right? We're not talking about moving mountains here. We're talking about 30 basis points, literally where my cursor is if you're watching this on video. But ultimately, PCE, for those that are just listening, has to just breach the 2018 highs. And we're about 30 basis points above there. So it's not a very significant move. It's not like we need to go down to the lows to really get the Fed in the mode to hike. In the mode to cut. And I do think that rate cuts are coming. Now, as you were saying earlier about the NASDAQ, look, the NASDAQ is melting up in a way that it's pushing, consolidating, pushing. It's been doing that since the April lows. Now, there's something that catches my eye when I look at this too. Obviously, we're in a slowdown is not a recession. So just because we're in a slowdown, the market doesn't need to nuke, right? The NASDAQ doesn't need to go down significantly. Bitcoin doesn't need to go down significantly in slowdowns. It's just because we're in a slowdown doesn't mean risk on is in the gutter. In terms of slowdowns, right? You have to look further into the data. What I will tell you is this: we're almost 12% above Momo. Okay, and I've seen the NASDAQ and I've studied this enough to know that we don't have prolonged move. We do not see major extensions like this last for a very long time, meaning like we're not going to go up another 12% from here from Momo, most likely. So either we're going to get consolidation or we're going to get some sort of pullback. And that pullback is likely going to test a lot of people who have been buying the entire breakout coming into June, right? This entire year breakout of the year, everyone's like all bulled up saying, okay, time to go. They buy in here and we go up. I mean, we can even look back. You always get that you can call it a value test. That's what I like to call it, right? Like you get that value opportunity. If you're bullish, the trend is bullish and you're optimistic, the market will give you opportunities to set yourself long and then to take profits. And typically it's seen around Momo. I mean, we see it, we tend to see it quite frequently in regular bull markets. And if we don't get the pullback to Momo, what ends up happening is we get the consolidation and Momo catches up. So right now, Momo is at 437 on the NASDAQ. The NASDAQ is at 496. So there's about 12% delta or difference here that either is going to be made up in time or in some type of price snapback. Now, I'm not telling you the Nasdaq's going to fall 12%, but this is a very interesting spot. We're at upper vamp, new all-time highs, and pretty extended from Momo. So we're at a point where price could pull back somewhat, consolidate before going higher. We don't not short at Market Radar. I am not telling or I'm not saying this is a good short. I'm just suggesting in a risk to return dynamic, we are quite extended from what we consider value in the trend process.
And this is a good lesson as well for trading is with trading, you're never going to have a 100% successful chance for a trade. It's always the odds that you got to play. And right now, with this overextension in the Nasdaq, it doesn't seem like the odds are here. And going back to that conversation on how the Fed's unemployment target is already missed and we're above it and we're on track to being above their 2025 target as well. That's hinting that there's more cuts that are going to be needed, and it's not really priced in the bond market and in the Fed funds futures market either. So I think the odds for a trade there are much more in our favor than longing Nasdaq at this point.
Right, but you're going to obviously need the regime to line up to really give that confidence, right?
Oh yeah,
So that's something
100%.
that, yeah, right. Like that's how we do it at Market Radar. Not only do we need the trend, but we need the regime. We get both of those together and fireworks go off, right? And to your point here about the Fed funds futures and what they're pricing in, what you can see here is the latest implied yield. If you're watching, if you're listening, I'll explain it verbally. But long story short, there's a nice steady decline in the Fed funds futures curve going out through 2025, right? Very, very calm. It's much higher than it was in 3 months ago and way higher than when it was 6 months ago. And what I mean by that is the bottom rate at the end of 2025 is much higher than it was 6 months ago. And it's slightly higher than what it was 3 months ago, meaning that there's less cuts priced into the market than there was 3 months ago, and significantly less cuts priced into the market than there was 6 months ago. Now, the difference of this is if we go to a 2020 end of 2025 timeframe, it looks to be about 125 basis points. 100, excuse me, 100 and not 100. I'm sorry, that's a blunder. 75 basis points. So there's a difference of 3 cuts. A 3-cut difference, right? By 2025. So what that tells us is not that there needs to be 3 extra cuts in the curve, but the curve has shifted up equivocally 3 cuts across basically on the slope, right? So what we need to understand here is all it takes is a couple of cuts to emerge in the next 12 to 18 months to significantly lift bond prices to a point where you may not get a long-term trend out of it, but you'll get a nice pop out of it. Maybe the pop is...
What were bonds trading at when they were pricing in those cuts from 6 months ago?
So when the long end was looking at, I don't want to say long end. When TLT was, when the Fed funds futures were trading around 3.5% roughly for 25, that was 6 months ago. The bonds were trading pretty much around 97 to 100, which is essentially, we do some math here. It's about 6 to 7% higher from here. And then we're talking about bonds here, right? 6 to 7% upside. The question is, again, and where we need to pay attention to, is what the progression of this looks like. Does this curve get distorted as the Fed pushes out rate cuts, and then this curve gets pushed drastically lower because the Fed has to panic cut? Meaning, do these implied cuts that are supposed to happen this year, do they get pushed back? Maybe we only get 1 instead of 2, for example. And the data starts to materially deteriorate, and the Fed has to start chopping 50 basis point clips, right? And therefore, the end target here is a lot lower than where the market's seeing right now. Therefore, we're actually going to get more easing than what the market even thought 6 months ago, type of thing. That's a dynamic that we're working through right now. But ultimately, I think the base trade here if you're talking about bonds, is going to be the first cut, like the first cut where the bond market is forecasts the future cuts to go, the Fed funds futures, right, where they basically price in the path of Fed policy going forward, and then how that's executed. So, simplifying this all down to an easy to understand trade, I guess I should say, we really need the bond market to pick up 1 to 2 rate cuts in the longer term to give life to the bond trade. But then we're going to have to see the Fed really come in and start pushing rates lower considerably to get that bond trade to flow with momentum. Because what's going to happen here is, even if you get down to you're playing long bonds, right? So you're really playing, the way you should think about long bonds is not so much how many cuts are going to be priced in the next 3 to 6 months. You want to think of, like, imagine the long-term average rate over the next 30 years. What do you think the average rate is going to be that's deemed by the market and based on inflation and growth, right? Like, if the Fed is going to cut once and then they stop cutting for a year, then long bonds are going to go down. Like, long end yields are going to rise, right? Because that's just what's going to happen until the economy forces the Fed to cut. Because the Fed can't really control the long end of the yield curve. They can to some degree, but it's more free floated than the front end, right? So ultimately, we're going to need to see more for the bond trade to work really well. You want to see more cuts come in than what's being priced in by the market at the current time. So right now, if we get exactly what is being priced in by the market, the Fed cuts exactly the way the market's forecasting, the long end doesn't go up. Long bonds don't really go anywhere. The
Yeah.
objective here is that the Fed is going to have to cut a lot more than the market is even forecasting. That will therefore open up upside for bonds to normalize at higher prices and yields to come down and normalize at lower yields, right? Because the idea is that the rates are going to have to move because the Fed is moving more than the rates have already priced in. That's
Yeah.
how the bond market
And
works.
for us to get that, we're going to need to see growth slow down even more, potentially even go to recession territory and see unemployment rise drastically. That's really what needs to happen. Is there anything else that could happen? I guess if something breaks, that's always a big kicker in bonds if we get another like SVB type situation. But I don't know really what's going to break right now, but who knows how it develops. I mean, I feel like
Yeah,
at this level of restrictiveness that we're at, somebody's getting squeezed somewhere. And it's only a matter of time till something breaks. And the longer the Fed puts off rate cuts, the higher the odds of that happening are.
right. And like, we could just look at the labor market supply rate. And we've spoken about this multiple podcasts now, even on X, right? Well, you'll notice here is that we're at 1.27 after the jobs numbers, the JOLTS and unemployment numbers this week. And it's not down significantly in terms of historical context. It's actually still kind of tight, but we're way off what we were seeing in 2022. And ever since the Fed started raising rates, this has pretty much gone straight down. Now, what this is telling us, and the reason this is important, is if you take a look at the unemployment rate, right? We look at what's going on there, which we know it's at 4.1%. Well, you could make the case that the reason this has been going up so slowly in a what we would consider a restrictive environment, and it hasn't really been budging, is because there's a lot of pent up excess labor in the system, right? Like, there's a lot of job openings per unemployed person. This is, Canada doesn't have this issue. It's very clear. Canada has a drastically different issue where they actually have less than a half an open job. Not even one, not even a half of an open job per unemployed person. In the States, we have nearly 1.25. So there's an excess of labor versus unemployed in America compared to Canada, which is why Canada is seeing much more drastic, or much more, I should say, accelerated weakness than we are in the States. For this reason, the excess labor is a lot lower in Canada than the States. So now you have to take it back and say, okay, well, if there's excess labor in the system, are people going to automatically lose their jobs first? Well, they'll lose their jobs, but it's not going to be as accelerated because they're going to be able to find another job, right? There's excess labor in the system. Although that excess labor is dropping, it's falling, they're able to pick up another job in the meantime. The problem comes into this, the problem is basically develops into an issue, or this becomes a problem and develops into an issue in the situation where excess labor is gone. Then you're really just breaking down the employment, the entire employment sector. Or I don't want to say that like that. You're once excess labor is removed from the system, you're essentially just straight up losing jobs and they're not being replaced, and your unemployment rate is going to start ticking up more consistently and probably more stiffly, right?
Yeah, and
Because
that's
you're
why historically, like, unemployment starts rising slowly, and then all of a sudden it starts shooting up really quickly because you
right.
have all these people that are like they're losing their jobs and then they're getting jobs fairly easily, and then you just kind of have a group of people losing their jobs, not able to get a new job for a while, and then more people losing jobs, not able to get jobs for even longer, and that just kind of compounds on itself. And then before you know it, like, a ton of people are unemployed and they're not able to get jobs, and that's when you start getting that accelerated movement in unemployment.
Right. And until we really see that breakdown in that excess labor, which we've seen it weaken quite a bit, but until we really see it, I think we're likely going to see this trend down towards this one mark, and we'll break down below there. I do not think we are going to have a recession in the United States, a real recession. Call it the hardest landing, right? The hardest of landings, with a labor market supply rate over 1. I really don't think so, right? Because I think for you to get that recession type of that economical contraction, you need to have a real shortage, something similar to what Canada is experiencing right now at point 4, point 5 open jobs per unemployed person. We're at levels pretty much consistent with what we were seeing prior to the pandemic. And those levels were reached as we rose up from under 1, meaning going into 2018, we were under 1 of job openings per unemployed person, and we started rising through 2018 into 2019, and we started to build up this labor excess. COVID hit, this went all the way down to pretty much 0.25 and rebounded very quickly with the mass stimulus and big push from the government to revitalize the economy, and it exploded with all this easing all the way up to 2. And now we're back to 1.27, which is, again, in line with what we were seeing pre-pandemic. But I think we're going to have to see this come down quite a bit more to get that real recession. This is not to say that the Fed can't. What I mean to say is this can happen in a manner that might be rapid at times, right? Just because it's gone from 2 to 1.7 in roughly 2 years doesn't mean it's going to take, a year and a half, a year to get from 1.27 to 1, right? Because as things start accelerating, like you just said, they become somewhat exponential, where job openings start dropping rapidly and people start becoming unemployed at a much more rapid pace. And this rate or ratio starts falling more aggressively. And I think, or in a panic fashion. And I think that once we see this under 1, I'd be more confident in saying like a recession is close, or at least this at 1, the odds of a recession happening are much higher. Right now, I think it's a little bit unrealistic to think that we're going to get a recession tomorrow. But it's not to say that the slowdown can't lead into a recession, right? The slowdown can certainly create a recession, which then in turn, or the slowdown itself brings this rate down, and that slowdown, it goes untreated, and then you get the recession. That's certainly a possibility. But I want to bring this podcast back before we finish up and end on Bitcoin, because this has been an interesting asset the last couple of weeks. A lot of emotions going on in the crypto space. People unsure if we've cycle topped, or if we've bottomed, or if it's just cooked for
Well, we've had a
crypto.
lot going on this week too, with like the Mount Gox redistribution and Germany selling Bitcoin. Just a bunch of weird shit happening in the crypto space this past week. But
Yeah. So
I don't really know where it's going to go from here. I mean, it's bearish trend. Bearish trends tend to lead to lower prices, and um, so I'll just follow with that. But
I
crypto is
tend
kind of a wild card.
I tend to agree with you there. Look, bearish trends tend to lead to lower prices, right? So we know for a fact the trend's bearish. That's undisputable. Question is now, does the trend reverse quickly? And if it does, we'd be more open to long Bitcoin. But I posted on X multiple times now this week. We sold all of our Bitcoin out of the RQF around 63,000. So we've been out of Bitcoin for some time now in terms of like actual size. And I think that given the move that we've had, there's a lot of people that are trying to say that this is the washout, we're going to reverse higher. And that might be the case. But I think you have to take a step back again, respect the trends, because when the trends are bullish and they work, they really do work. They really like it works when it flips on risk on and it goes up. When it flips risk on, price really does go up, right? That's the whole point. And when it flips risk off, in terms of the trend, bearish trends, price really can go down, right? So bullish trends, price really can go up. Bearish trends, price really can go down. So I think we have to respect that. And I'd be more inclined to talking about re-adding Bitcoin, buying some more Bitcoin if we can get back above 66K. And the models would likely like that as well. I know they would like that because at that point, Bitcoin would be edging back into bullish trend. Things would start looking more. Things would start to look more optimistic, and things would be overall healthier in terms of price structure. Some will say, "Oh, we've defended the Q2 low or whatever, the May low." Yeah, this is true. We're not on the bottom of the candle, but this is also Bitcoin, right? It's got a 50 to 80 vol. Like this can move 5% by the time this podcast gets uploaded, right? So we have to understand that this is a high vol asset. That's why you have to have the rules and respect them. And Bitcoin is one of these things that is very hard for people to quantitatively understand because every in the finance space, you come up under assets with volatility of, we're talking about 10, 12, 15 vol, right? In Bitcoin, it's literally one of a kind. There isn't an asset with this type of vol out there. So a lot of these quantitative models don't have the foundation from the ground up to be built to handle this type of volatility. So what ends up happening is Bitcoin breaks a lot of models. People get very scared because their models go kaputskis in the most inopportune times. And I think that the biggest problem you have to pay, or the biggest problem or the biggest concern you should have with this is not to get faked out with FOMO. If you build a process, you need to have the conviction to execute that process. If you can execute that process with conviction, you're less likely to run into a situation where you're buying and then getting scared and selling within a few minutes or selling within a few days because you're just unsure, right? Conviction gives some sort of certainty, at least within your process. And I think without the conviction, you end up in this situation where you're checking the charts at night. You're scared. Is Bitcoin going to nuke while I'm sleeping? Am I too leveraged? Right? There's all these like irresponsible, or I should say, unnecessary nerves that come in because you're somewhat irresponsible in terms of executing something you don't fully believe in, right? And you have to have that conviction when you execute, especially on Bitcoin, because for Bitcoin by the end of this weekend can be at 65K. Will I be upset? Absolutely not. There's no reason to have FOMO. We just caught the move from 43 this year, starting this year at 43, now out of 63. We're not going to sit here and worry about 5,000 points on Bitcoin. Well, what's the point of this, right? If you have the conviction, you execute and you move on and you wait for the next sub to emerge. You don't sit here and worry about what could have been, what should have been, buying the lows. I missed the lows by a candle. Oh my God. Time to leverage up to make it up for it, and then you get liquidated, right? That's what happens in this space. So you want to be very consistent with how you execute, because if you cannot scale the process and repeat the process, you don't have a process. And I think that's where I want to wrap up this podcast this week. Thank you so much, guys, for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.